Welcome back. Well, what a turnaround in the market. The Nifty is at the high point of the day, 60 points now in the green. The Bank Nifty is 177 points in the green. Just to give you an example, the 19,500 call of tomorrow's expiry on the Bank Nifty from 150 has moved to 350 in a matter of last 15 minutes. That is the Wednesday magic when it happens on just a day ahead of expiry, especially if everyone gets on the one side of the market moves on the other side, and that's what the market seems to have done for now, at least. Gautam Duggad is joining us, head of research at Motilal Oswal Financial Services. Gautam, hi, good morning. Thanks a lot for joining us. The April rally is getting sold into a little bit, though of course today we are seeing a bit of a bounce back. But your thoughts on whether there's a risk of this market revisiting the March lows?
Hi Anuj, good morning. I think we've seen a good 30% up move from the bottom of March in April. More importantly, the volatility which was sharply elevated in March has dropped significantly in April, and accompanied by a big moderation in FI outflows rather. So we saw $8 billion of FI outflows in March, which came down to just a trickle of $0.2 billion of outflows in April. So that helped a lot. Plus, obviously, global markets are benign, and there was always this recurring talk of some fiscal stimulus here or there, which we have not seen so far. So that helped. And plus, a lot of sectors had seen huge damage. So there was some buying which came in. What I feel is, looking at the fundamentals, looking at the earnings, see FY21 earnings has no meaning. Nobody has a clue how it will turn out. As of now, we have 0% expectation of growth for FY21. And I think this is the first year in my 6 years of doing this exercise where we started the year with a 0% kind of a growth right at the beginning of the year. Every year it is usually 15-16%, and then we go down to 4-5%. This year it started with 0. Whether it becomes +5 or -10, we will know as things evolve. But if you were to just look at fundamental picture and the kind of damage that some sectors are seeing, I think it is fair to expect that market can remain in this tight range. And if I have to put a number, I would find 10,000 Nifty, which we have seen, is something of a level from where at least fundamentals don't allow it to move further from there. Till we see more clarity on the earnings picture, till we see some sort of a stability, whether the lockdown is getting over or not, and more importantly, how financials are going to be, looked at, because they still are around 30% of the total Nifty earnings, and despite the fall that we have seen in the last 2 months, financials is still 37% of the Nifty index. They were 42% 2 months back, but even 37% is huge. So till you see some sort of a clarity and some sort of an understanding where things are going to settle in this big pack, I find it difficult to see in this new environment Nifty crossing 10,000 easily.
All right, the price is another issue altogether, Gautam, but let's just discuss earnings. I remember immediately after those tax cuts were announced, the number doing the round as Nifty EPS for FY20 was about 600. What's the current number for FY20? I'm not even asking you 21.
Lala, that 600 number has already come to 570, 565 by September, which then subsequently came down to 532 after the third quarter results ended. When we did the preview 10 days back, our estimate for FY20 stands at 485 rupees. And by the time this result season ends, I won't be surprised if we end somewhere close to 475, because the first 10 Nifty results that we have seen has shown a lot of weakness, be it Axis Bank or HUL or Tech Mahindra, or even Reliance numbers missed the expectations. If you look at the reported earnings, obviously a lot of people will adjust for that inventory loss. We've taken it as a recurring thing. So I think 475 is the FY20 EPS, which is flattish, and our expectation of FY21 is also flattish. Whether if it is flattish, well and good, but we will see how it pans out. So for now, it's fair to say that 3 years you will have almost flattish Nifty EPS, FY19-20.
Okay, we'll just get back to you. That phone line is tricky. But we should get back to Gautam in just a minute. Just redialing him. The market is not listening. The earnings can be downgraded to flat earnings from FY19 to FY20 and flat again from FY20 to 21. But market at the moment in the grip of bulls. So we will get Gautam Duggad in just a minute. At the moment, actually, we maybe need to pay a little bit of attention even to the slightly weaker stocks like Vodafone Idea after the CNBC TV18 news that they are finding a buyer for their optic fiber, and they found good interest from two PE funds. We have seen that stock also move up. Of course, 2.5%. It was even 4% up. Doesn't mean much in terms of amount of money since it's a penny stock now. But there are some decent gains notched up even in stocks like Bharti. So telecom in a good place. Sonia, anything you're spotting?
Well, yes, even autos, I mean, there are no sales in the month of April, but stocks like Hero MotoCorp are surging up almost about 3%. Metal stocks, Hindalco, Tata Steel are all in the green right now. And by the way, the mid-cap index also is up about 1%. So there's definitely a lot of traction from the lows. But I guess, Lata, the problems still continue, right? No one knows the impact of the COVID, the damage that COVID would do. So at some point, the volatility would re-emerge. But in terms of individual stocks, you have a lot of these NBFCs that are starting to bounce now, whether it's Cholamandalam Finance up 5%, M&M Finance up 3.5%, some cement stocks also looking pretty good. But as I said, maybe volatility could re-emerge, Lata?
It is, but since we've got Gautam, let's make good use of the telephone lines while they oblige. Gautam, okay, just give us some. You told us that the first 10 earnings in FY20 have not been very flattering, and so you're bringing down your earnings estimate. Where do you see the major weakness? Where do you think you will be tweaking your FY20 earnings first?
Not the FY20 is as good as done, right? Whether 475, 480 or 485 is a matter of semantics. I think the attention right now is to see how FY21 pans out. Let me give you one data point. We've seen a 30% earnings cut when we did our preview for FY21. Now 70% of the 30% earnings cut came from just three sectors, which is metals, oil and gas, and financials. Where we are still seeing some sort of stability in earnings or not major downgrade is pharmaceuticals, consumer, and then IT. So basically the pain is more concentrated in a couple of sectors, cyclicals and commodities. And as you would rightly expect, they are the sectors which eventually, as and when it happens, should also lead the bounce back in earnings. But for the time being, these are the three sectors we have seen maximum damage in earnings. What I feel is that the situation is extremely fluid. 30 days later, when we speak again after the earnings end, maybe this number itself would have changed drastically, because all of us, when we did these numbers, we worked with the assumption of a May lockdown ending. What if this prolongs? And even if it is lifted, how different sectors react and how soon we come back to normalcy is something which will have a tremendous repercussion on FY21. So that's why I said looking at FY21 earnings right now is a bit futile, and it's beyond the realm of prediction. And FY20 is too far. So right now we will have to go back to fundamentals, look at cash flows, look at the sectors which have cash on the balance sheet, and sectors which can withstand this 1-2 year of turmoil from a balance sheet and cash flow perspective rather than just P&L perspective. So that's the thinking we have right now.
Okay. Gautam, hi, morning. I just had one question on the FMCG earnings itself. Because of how consumer preferences have moved from discretionary to staples in this lockdown, do you see better earnings for the likes of an HUL, Imami, Dabur, Marico? We saw, Saffola volumes went up 25%. Do you see better earnings here?
Yeah, I concur with that view. I think staples obviously remains a no-brainer. They will have the least damage, while livers volumes are slightly weaker than what we expected or forecasted. I think this pack, which is a liver or a Dabur, Nestle, Britannia, they are far better positioned from an earnings perspective, and which is why you are seeing a far less of a damage in their price performance as well. While one can keep debating about the 1 year forward P, right now I think people are looking for companies where balance sheets are strong. There is a cash in the balance sheet, and relatively the earnings damage is slightly lower compared to the other sectors. Marico's numbers were quite good. I think Asian Paint yesterday in your channel said that 1Q is a washout, and I think that commentary will be there across the board for discretionary companies, be it white goods, be it paints, or some other such discretionary names. Any which ways, apparel, retail, all of that shops are closed. Even jewelry should suffer in the short term for a quarter or two. So relatively, yes, I mean staples remain the hope within the consumption segment.
Will you hide, Gautam?
Yeah, so from our model portfolio, what we've done is we've been increasing the component of defensives since June 2019, which we've taken one notch further up. So I'll tell you, we had a significant overweight in telecom since March 19. That continues. We've increased the weightage of large cap tech in our model portfolio. So TCS is making an entry in our model portfolio. We have increased the weight on IT by 2%. Consumption remains there in our model portfolio. Where we have changed our call slightly in this revision of our model portfolio is on auto, which has been neutralish for us. We've gone contra and made it a slight overweight, and pharma, which was neutral, we have made it a marginal overweight. But we still remain negative on the cyclicals, the commodities like metals, oil and gas, construction, real estate, capital goods. I think pharma, infra as a space will see a lot of pain because the governments are constrained for capex and fiscal spending. So clearly, spending on infra will remain will not remain the most important priority for them. So clearly, private capex revival, which we've been talking about for 5-6 years and getting postponed every now and then, we'll see further pushback now. So it's very important to remain concentrated in few sectors where the balance sheet and cash flows are strong, and maybe at the margin play around with some calibrated risk in one or two sectors. The reason why we went overweight on auto now is we believe that the auto sector has been in turmoil for the last 2-3 years. So valuations are looking quite juicy out there. Within that, we are focused on players with cash on the balance sheet like Maruti and Eicher. So that's how we are positioned right now, or hiding right now.
Okay, thank you very much for joining us, Gautam Duggad, with that analysis of the year that still looks like we don't know how it will go. Thank you very much for that. We take a quick break and now we shift to the money market.